Hi everyone, my name is Kevin Reidinger. I am a certified financial planner and chartered financial consultant here at Chartered Financial Services. And today I want to talk about year-end tax strategies for every generation. And I want to start off by talking about your employer-sponsored plan, specifically the traditional 401k. So that's the first thing we're going to want to look at the end of the year. We want to maximize our contributions if we can. Right? If you've contributed about $15,000 to the traditional 401k, and maybe you want to contribute $20,000 to get another $5,000 worth of deductions, let's take a look at that. Let's take a look at maximizing the traditional 401k to get those deductions. Also, if you do qualify to contribute to an IRA, maybe you have an individual retirement account, the maximizations there are a little bit lesser. It's $7,000 if you are younger than 50. If you're over 50, you contribute up to $8,000. So maybe, for example, you've contributed $4,000 to the traditional IRA, and you want to maximize that to $7,000 if you're younger than 50 years old. So let's think about at the end of the year maximizing all of our employer-sponsored plans, traditional 401ks, and traditional IRAs to get those maximum deductions for the year. Next, I want to talk about Roth conversions. If you have a lot of value built up in your traditional IRA, maybe you want to think about converting some of that money to a Roth IRA. One thing that we do have to take note of with this strategy is that you will have to pay taxes on that. So if you have a large IRA, maybe we think about converting over a certain number of years so we don't bump you up into the higher tax bracket. So with this strategy also, we want to think about what tax bracket we're in. Maybe we're in the 22% tax bracket, and we want to maximize the amount of that bracket that we're in and convert that amount of the traditional IRA over to the Roth IRA. This is a great way, even though you're paying taxes now, the built up value that's going to happen in the Roth IRA, you'll be able to take out tax-free later on in retirement. Another thing to note is that when you do take out from the Roth IRA, or when you do get to that age when you start having to take RMDs, they don't count the Roth IRAs for required minimum distributions. You can let that account grow and build up that tax-free income for yourself, you and your family. Ultimately, when it does get, when you leave it to your children or maybe grandchildren, they are able, even though they have to take it out within 10 years, they're going to be able to take out that money tax-free as well. So it's a really great strategy to build up that tax-free account for you and your family. Another strategy that we constantly are looking at is tax loss harvesting. And this is something that a lot of people wait till the end of the year to do, but really we should be looking at it throughout the year in order to maximize our tax position. So if I have a brokerage investment account or a managed investment account, and I have a position in there with $10,000 worth of gain, and I also have a position in there with $10,000 worth of loss, we can net those out and you can realize a 0% tax at the end of the year. So we always want to constantly be looking at that throughout the year. If you have a financial advisor or financial planner to talk with about this strategy, they should be giving you these tips and tricks throughout the year to try and maximize those tax brackets there for you. Next up, we have qualified charitable distributions, or QCDs. If you are of the age where you have to start taking your required minimum distributions, this could be a great strategy if you don't want to have that income for filing for taxes. So you can choose to donate up to $100,000 to a qualified charity, and you get to support your favorite charity, and you get to satisfy your required minimum distribution for the year. This is a great strategy for those philanthropic individuals and families.